As of this moment, with the market live and in full session, Opendoor Technologies Inc., trading under the ticker OPEN, is priced at $9.07, experiencing a sharp downturn of 13.78% in today's trading. This isn't just a minor fluctuation, it's a significant intraday bleed that immediately forces us to ask a critical question. While the crowd is mesmerized by the year-to-date gains that have bordered on the spectacular, with the stock surging from near delisting lows, today's reality paints a much more sobering picture. The common expectation has been that Opendoor, the poster child for the iBuying revolution, is a high-beta phoenix rising from the ashes of the 2023 housing market freeze, a narrative fueled by a recent leadership overhaul and a flurry of retail investor enthusiasm. But the reality, reflected in today's brutal price action, is that Opendoor is not merely a housing market play. It's a deeply complex technology and finance company tethered to the unforgiving mathematics of interest rates, inventory risk, and a business model that is still fighting to prove its long-term viability. The market is pricing in a story of recovery, but the underlying mechanics suggest a story of profound, persistent risk. Many investors, particularly those managing their portfolios through platforms like Fidelity, SoFi Invest, or even Robinhood, have been drawn to the Opendoor stock saga. It embodies the high-risk, high-reward profile that can define a self-investing journey. The narrative is simple and alluring. Buy the dip on a disruptor in a massive, antiquated industry. The expectation is that as the housing market thaws and mortgage rates stabilize, Opendoor's algorithm-driven model will reign supreme, swallowing market share and delivering exponential returns. This belief was bolstered by a stunning 142% rally in August, driven by a cocktail of meme stock energy, optimism over Federal Reserve policy, and significant leadership changes, including the appointment of a new CEO from Shopify and the return of co-founder 𝐃𝐈𝐒𝐿 to the board. It felt like the smart money and the retail army were finally aligned, creating the perfect storm for a sustained rally. People looked at their Schwab Intelligent portfolios and saw a tech-forward real estate play that seemed to be de-risked by new, credible leadership and fresh capital injections. But today's sharp decline serves as a harsh reality check, exposing the chasm between this comeback narrative and the operational hurdles the company still faces. The deeper reality is that Opendoor's success is far less about capturing the zeitgeist of online investing and far more about navigating a treacherous macroeconomic environment. The company's core iBuying business model requires immense capital to purchase homes, make minor repairs, and then resell them for a slim profit. This model thrives in a low-interest rate environment with high transaction volume and predictable home price appreciation. The current market is the antithesis of that. While the Federal Reserve has signaled potential rate cuts, mortgage rates remain stubbornly high, locking many potential sellers into their current homes and stifling transaction volume. Opendoor's recent earnings reports reveal this strain. While the company impressively beat revenue estimates in the second quarter of 2025, reporting $16 billion, and even achieved a surprising positive adjusted EBITDA of $23 million, the forward-looking guidance and underlying metrics were alarming. The company's guidance for the third quarter pointed to a significant sequential decline in revenue and a return to negative EBITDA. More critically, the number of homes it purchased plummeted by 63% year over year. You cannot be a house flipper if you cannot acquire inventory. And this is the central crisis that the bullish narrative conveniently overlooks. The stock's recent surge was not built on a fundamental recovery in the housing market, but on speculation and a story of a future pivot. This is where the analysis gets truly interesting for those using more advanced platforms like interactive brokers, which allow for a deeper dive into institutional flows and options activity. While retail sentiment has been a primary driver, institutional ownership sits at just under 50%, and recent filings show a mixed, if not cautious, stance. Major holders have been observed reducing positions, hedging their bets against the very real possibility that the housing market's recovery will be slower and more painful than anticipated. The smart money understands that Opendoor is in a race against time, burning cash while it attempts to pivot towards a more capital-light, asset-light model. This strategic shift involves expanding its marketplace to connect sellers with institutional buyers and launching new partnership programs with real estate agents. These are intelligent, necessary moves, but they are nascent. They do not yet generate nearly enough revenue to offset the hemorrhaging in the core iBuying segment. The expectation is that this pivot will save the company. The reality is that it's a desperate gamble being made from a position of weakness, not strength. Let's take a moment to engage with the community here. Comment below with your honest take. Do you believe the U.S. housing market will see a meaningful recovery in transaction volume before the second half of 2026? Your answers will give us a great pulse on the sentiment driving stocks like this. Breaking down the business for a moment, Opendoor acts as a direct home buyer, using proprietary algorithms to generate near-instant cash offers for sellers, eliminating the uncertainty and hassle of the traditional listing process. They charge a service fee, typically around 5–6%, which is comparable to a traditional agent's commission. After purchasing the home, they perform light maintenance and repairs and then list it on the open market. The goal is to profit from the service fee and any appreciation in the home's value during the short holding period. When this works, it's a beautiful streamlined machine. But when the market turns, as it did sharply, the company is left holding billions of dollars in depreciating assets. This is precisely the inventory risk that crushed the stock previously and remains its single greatest vulnerability. The pivot towards an asset-light model is an explicit acknowledgement that this core business is too dangerous to scale in the current environment. This isn't just a minor tweak, it's a fundamental challenge to the company's original thesis. Investors on Fidelity, looking at the company's financials, will see a history of massive revenue figures paired with equally massive net losses. The path to sustained profitability remains theoretical, heavily dependent on external market conditions that the company has no control over. Looking forward, the outlook for Opendoor is a tale of two wildly divergent paths. The bullish scenario, which has fueled the speculative frenzy, hinges on several key catalysts. First, a more dovish Federal Reserve that aggressively cuts rates, leading to a swift and significant drop in mortgage rates. This would unlock housing inventory and boost transaction volumes, directly benefiting Opendoor's acquisition pipeline. Second, the successful and rapid scaling of its new capital-light marketplace and agent partnership models. If these initiatives can generate significant high-margin revenue, it could fundamentally alter the company's financial profile, making it less of a leveraged bet on home prices and more of a diversified real estate technology platform. The involvement of respected figures like 𝐃𝐈𝐒𝐂𝐋 and a fresh AI-focused vision from the new CEO provide a credible narrative for this transformation. This is the story many who engage in online investing through apps like Robinhood and SoFi have bought into. But the bearish reality is stark and grounded in the present. The primary risk is that the housing market remains frozen for longer than anyone expects. Sticky inflation could prevent the Fed from cutting rates as deeply or as quickly as hoped, keeping mortgage rates elevated through 2026. In this scenario, Opendoor's cash burn would continue at an alarming rate, potentially necessitating further dilutive capital raises. Competition is another factor. While Zillow and Redfin abandoned their iBuying operations, new, more disciplined regional players could emerge, and the traditional real estate industry is not standing still. Furthermore, the analyst community remains deeply skeptical. The consensus price target from Wall Street sits dramatically below the current trading price, with many analysts maintaining sell or underperform ratings, citing the massive disconnect between the stock's valuation and its underlying fundamentals. They see a company that is fundamentally unprofitable, facing immense headwinds, and being propped up by speculative fervor rather than a sustainable business recovery. In conclusion, the drama surrounding Opendoor is a masterclass in the tension between market expectation and operational reality. The expectation is a thrilling comeback story of a disruptive tech company led by a revitalized leadership team poised to conquer the real estate market as it recovers. It's a narrative perfectly suited for the modern era of self-investing, where compelling stories can drive incredible momentum.
The reality, however, is a company in a precarious financial position, attempting a difficult strategic pivot in the face of severe macroeconomic headwinds. Today's significant intraday drop is a potent reminder that narratives can collapse under the weight of reality. The path forward is not guaranteed. It is fraught with risk. The true test for Opendoor will not be its ability to capture the imagination of the market, but its ability to survive the harsh realities of the housing cycle and finally build a resilient, profitable business model. The story is far from over, but the easy chapter has certainly closed.